Let me first say that the COVID-19 pandemic has brought unprecedented challenges both for the people and the society at large, which have called for emergency measures in these exceptional circumstances. Banks have and are still playing an important role in supporting the economy and its recovery. EU supervisory authorities have also demonstrated an unprecedented capacity to act quickly, resolutely and effectively to mitigate the impact of the crisis on the financial sector. We at the EBA, in close cooperation with the other European and national authorities, have taken a number of steps to follow banks and to maintain their support to households and corporates at this very difficult juncture. From the onset of the crisis, our main concern was that banks could focus on their critical functions and operational continuity. The first decision that we took to postpone the EU-wide stress test exercise by 1 year and also to delay remittances dates for supervisory reporting and to put on hold consultation processes. All these were indeed aimed at providing operational relief to banks so as to allow them to shift resources where they were mostly needed. Second, we also reminded that the capital accumulated by banks was there to be used to ensure continued lending to the economy and encourage competent authorities to use the flexibility embedded in the existing regulatory framework to do so. We also felt the need to address the prudential treatment of legislative and non-legislative payment moratoria. We fast-tracked guidelines on moratoria to avoid the automatic reclassification of forborne or defaulted status of loans under moratoria. But we also confirmed the necessity to ensure that the risk is identified and measured in a timely and accurate manner. Our recent decision not to extend further our guidelines on moratoria signals the importance, after the peak of the emergency, of a timely recognition of risks. In the short term, the challenges continue to be to provide adequate financing to the economy. Of course, this involves a proper assessment of each counterpart to ensure they serve clients according to their specific situation. Notwithstanding unparalleled fiscal, monetary and supervisory measures deployed by the European Union and national authorities, the economic crisis will hit the sector hard, and we will observe a deterioration of credit quality and decreases in profitability. According to a sensitivity analysis we carried out early in the spring for assessing the impact of COVID-19 on EU banks, Stage 3 assets could increase to levels comparable to 2014, and credit risk losses could determine a decline of core equity tier 1 ratios between 230 basis points and 380 basis points. The 2021 EU-wide stress test will allow us to better assess the consequences of the crisis on banks, start discussing possible exit strategies, and set supervisory expectations on capital planning. Although European banks entered the COVID-19 epidemics in a good starting position, with large capital levels and abundant liquidity, there are structural vulnerabilities in the sector that existed prior to the pandemic and are being exacerbated by it. Profitability levels, which have never recovered since the last crisis, will remain subdued amidst lowest interest rate margins and banks' significant challenges in reducing operating expenses. But there is also the issue of excess capacity and the need to adapt business models to the technological transformation. The uncertainty about the evolution of the pandemic and the speed and strength of the recovery remain very high, so I think banks need to continue to properly assess risks in their portfolio in a continuous manner. Banks also need to address the structural vulnerabilities related to lower profitability, enhancing their cost structure and the structural change to ensure the sustainability of their business model going forward. Regarding the regulatory front, I think that high capital, ample liquidity, improved asset quality, enhanced digital capacity, and stronger risk management have all helped banks to respond to the emergency. This confirms to me the importance of a sound regulatory framework and its effective implementation. Although there could be aspects of the existing framework requiring a critical review and possible changes, I think that at this point in time, what is needed is more a fine-tuning and calibration of the framework rather than a fundamental rethinking of it. I would also advocate taking enough time to reflect, discuss, and make decisions, as changing the rules while the crisis is ongoing could be premature, imprudent, and could also be interpreted as a signal of weakness of the banking sector at a time where markets are volatile and investors nervous.